worked quite well. So let's talk about something else, which has been in the news and also makes little sense and has upended all of our expectations, and that's oil. And luckily, we have on faculty Professor Jeff Colgan, who is an international relations scholar of some renown, who also happens to be one of the few people who really, really understands the sector and the geopolitics therein. So looking forward to having a good conversation about that. So, Jeff, let's get started, shall we?
Sure. Yeah.
You ready? All right. Let's get started with this. I posted something on Twitter just the other day, which was a very short thing that said, well, that's unusual. And that was negative oil. Can you walk us through how you get to negative oil? Let's use that as our starting point.
Yeah, it's been a crazy last couple of months for the oil markets generally. We've never seen oil prices go negative before in basically a century and a half of the oil markets. But I think of this as sort of three crises at once for the oil markets. There was the first phase of the coronavirus in China, which hit world oil demand very dramatically. I mean, demand in China, but that ultimately means world oil demand. The second phase was a spat between Saudi Arabia and Russia, or more broadly, the sort of OPEC plus group of countries that were trying to prop up the price of oil. And then they started to disagree starting on March 9th. And that led to another drop in the price of oil. And then the third phase being once the lockdowns were really in place in both Europe and North America, where you get this huge shortfall in demand, right? So they're talking, if you think about the whole world oil market as about 100 million barrels a day of oil, a drop of like 20 to 30 million barrels per day. And so even though there were some production cuts happening, it wasn't enough to compensate for the fact that we now have so much oil production supply and not enough consumers for it. And that means that we get to this point where producers don't know where to put the oil that they're producing. They can't stop production easily because it damages an oil field to do a sudden hard stop of oil prices, of oil production rather. And so you get into this weird situation where the producers are actually paying others to store the oil that they're producing, and that gets you negative oil.
So, but is this going to persist? Is this something that we're going to, continue to see? Because it's very difficult to build another Oklahoma storage facility overnight, and it's not clear that the airlines are coming back anytime soon. So, should we expect this to persist? And if we do, how significant is that?
Well, I think we should expect low oil prices to persist. Probably not negative ones. In a certain sense, that there was like a really weird technicality associated with the day. It was only one day where prices went negative, and it had to do with futures contracts rolling over to actual physical delivery. Now we might see, another day or two of that in the future at those moments when the contracts change. But generally, I think we should expect just low oil prices for some time. As you say, demand is going to be depressed for a while. And of course, how long it's going to be depressed is the $64 trillion question right now. Nobody knows. But it seems as though that stretch of low prices is going to last for a while. And that's going to cause a lot of economic pain for oil producers in this country and around the world.
Let me just say to everyone who's listening in, first of all, welcome if you've just joined. I know some people are joining us now. The Q&A is actually open. We're using Zoom as the platform if you have access to that. We also have people watching comments on YouTube and other such things because we're doing YouTube Live. So if you've got any questions, put them up there and we'll try and get to them in the latter half of this broadcast, which is when we'll open this up to Q&A. So just putting that in there. Now let's get back to what you were just saying there, Jeff, right? One way I'm thinking about this is you have the Fed, the Federal Reserve, basically propping up asset prices everywhere to stop a complete financial collapse. And therefore, the stock market's rising at the same time that unemployment is skyrocketing, which is a rather weird one. Yeah. In a sense, is the oil price a better indicator for the true state of the health of the world economy than anything else at this point, in the sense that it went negative and there's a lot of information in that? Is it more than just a technical blip in that sense?
Yeah, we're getting sort of, as you say, this very strange constellation of signals, right? Where the stock market seems to be doing relatively
Okay-ish, yeah.
okay,
If
right?
you
It's
know the
obviously
Fed's going to buy everything, why not buy it, right?
right. Where, and, if you compare to a year ago, the stock market is only down just a little bit, whereas unemployment is just awful, and I think that's actually probably, to my mind, one of the better signals.
Yeah,
But also, as you say, oil prices is a good one. I think negative oil prices is unusual. It's kind of a freak occurrence, but the massive reduction in demand, that's a true signal of what we're seeing right
yeah.
now and what we can expect at least for a couple months.
Right. So let's talk about different countries, different economies, the ways in which this impacts them in different ways. We've mentioned the US, who basically got the shutdown of the shale producers. They're basically been very hard squeezed on this. What's the story for net importers? Let's start with the EU. What's happening there because of this? Is this a boon? Is this a problem? How does it work out?
Well, it will benefit net importers, including in Europe, other than Norway, of course, which is a big exporter, but most of Europe is net consumer. And the trouble is right now, everybody's in lockdown in Europe, and so you can't take advantage of those lower prices. But I think once, and we're seeing already, even starting this week, European countries coming out of the lockdown, then there will be sort of an updraft for the economies of those countries from the lower oil prices.
Mhm. Would the same be true of the East Asian economies as they come out of lockdown?
Absolutely. So China in particular is going to benefit from this. It's a very heavy oil consuming country, big net importer. Same with Japan, Taiwan, elsewhere. So they will definitely benefit.
So what about the producer countries? You mentioned Norway, but let's talk about the Middle East. What happens to those guys in particular?
Yeah, so the Persian Gulf, of course, is going to be very hard hit. This is very bad news for net exporting countries, and in particular, not only the countries that are pumping heavily just to meet their government's budget, but also the ones that don't have a lot of fiscal reserves, right? So that's a double whammy, because then they're going to run a big fiscal deficit, and they've got no cushion in terms of a piggy bank. And so
Which
there,
countries are you particularly thinking of falling into that bracket?
yeah, thanks. So in particular, Algeria, Iraq, Nigeria to a certain extent, Angola heavily. Those are some of the big countries that I would be worried about, not only economically, but even politically, as the unrest starts to unfold because of the economic consequences.
So how does this play out in Latin America? Because they are commodity exporters par excellence.
Yeah.
Brazil invested heavily in these offshore deep well issues over the past decade. Is it the same story for those guys? I mean, basically, is it kind of the same problems writ large in a different continent?
Yes, Ecuador has already applied and basically said that they can't pay their debts and applied to the IMF for help. Venezuela is a continuing, ongoing mess. And other producers, Brazil and Argentina, are actually smaller oil producers, but they had made bets on being able to produce, and it's going to be very tough times for them as well.
Yeah. And in a way, just to pull back for a minute, it gives us a really interesting way of thinking about globalization. We tend to think about globalization in terms of trade, in terms of financial flows, but there's also these very basic things of oil flows and then the revenues that come from this.
Yeah.
So what starts as a kind of supply shock in China and becomes a demand shock everywhere else as we withdraw, becomes this absolute catastrophe for these commodity dependent countries that, as you say, have no real budgetary reserves, need to earn dollars to do basic imports. And already, Latin America is the best example, we're in deep trouble already. So there's very large repercussions coming from this.
Yeah, and it has these sort of ripple effects, as you say, kind of all the way around the world, where suddenly the Federal Reserve and other central banks are worrying about the kind of stability effects of having many countries in Latin America and Africa that are in deep financial trouble because of that. There will be some, it's not all negative, because there will be some positives in the sense that the price of fertilizer for agricultural products is heavily linked to the price of oil. And so for many countries that are producing coffee beans or bananas or whatever it is that they're producing, this is going to be a benefit down the road, but that's going to take some time to play out.
Right. So even though they're losing revenue on the front end, you get cheaper inputs on the back end. So it's going to see a redeployment of capital rather than, if you will, its complete collapse. If we get lucky. Let's try and accentuate the upside of this.
Right.
The air is fresher. You can see the arch in Delhi.
Right.
All the aircraft are grounded, so that's a large chunk of emissions gone. What's the environmental story on this? Because there's got to be a long run on this as well. Short run, you're encouraging more use, but you can't actually do it because we're all locked up. But eventually you would hope to get out, and then that will encourage more. It seems to be structurally low because there's so much supply out in the market just now. Does that get us further along the road to dealing with climate change, or does it hold us back?
Yeah. So with Earth Week just last week, I'm glad you're bringing this up, and I think you're absolutely right on both the sort of short term and the long term. The scariest thing that we are starting to see, though, is that some of the oil producers, faced with that problem that I was mentioning at the beginning of having nowhere to go with their oil, there's at least some reports now coming out of Russia, and this might become a thing for US as well, where oil producers are actually burning their oil rather than leaving it in the ground, right? So, which is, of course, from an environmental perspective, just a total disaster. And in the sense that we're in a point where we're already...
But hold on, why would you do that?
Yeah.
Why not just leave it in the ground, right? I mean, why do you have to burn it?
Yeah. It seems so crazy, but it really is this idea. I mean, I think intuitively we have this sense that oil fields are like a wine bottle, right? You could put a cork in it and come back to it later. And that's not the way oil fields are. That you have to keep the pressure up. If you do a sudden stop to them, you damage them and therefore lose the kind of revenue stream going forward because you've now damaged your oil field. And so
absolutely.
You're making this short-term trade-off, long-term trade-off there as well, where a producer might decide, well, if I keep producing now, burn it up or do whatever I need to do, then in the long run, when oil prices recover, I'll still be able to sell this stuff for a profit down the road.
So there's the question. I mean, none of us know exactly what the growth trajectory of the future is going to be locally or globally. But is this one in which oil is increasingly written out of the script? Or is it one that oil now has an unexpected comeback?
Yeah, so I think the story right now is all the headlines rather are all negative on oil producing, and that's right, that they're going to face a heck of a demand shock, and it probably will help people change their view about the attractiveness of renewables. But there is a countervailing force, as we've said on so many of these topics, in that, as you know, electric vehicles compete with internal combustion engines. And when gasoline is cheap, it makes the conventional cars a lot more attractive than their hybrid or electric vehicle competitors.
But all of that, of course, is contingent upon, in a sense, the global economy coming back pretty much as it was before. Right, so the Germans will make BMWs and they'll sell them to the Chinese. They'll make them here and sell them to Americans, and other countries will consume them and they will export them, etc. It's not clear, particularly if this continues through multiple waves of the virus, that those types of growth models, if you will, and those traditional industries are sustainable over the long run. So I'm thinking particularly of oil just as a business. Can't it go bust? Yeah. I mean, can't it ultimately just go bust because nobody's buying this stuff and the cost of capital is too high relative to what you get for taking it out of the ground, and game's over, right?
Yeah. I think that it doesn't go bust in the short term. Just it might shrink a lot, right? So even if we went from a world where we were consuming 100 million barrels a day down to 50, that's a massive shift in the structure of the world economy. That means whole countries stop producing oil,
right.
which could include my home country of Canada, which has high cost of production oil. You could imagine a total sweep of Alberta and Saskatchewan, which has got huge political consequences as well. But I'd love to ask to get your thoughts too about what are the other sectors that might disappear. You have to think about, cruise lines. Who's going to want to be on a cruise for a while? Or at least that's what I think, although I hear that some people are buying tickets into the future. So which sectors do you think are going to shift the most?
So this whole thing for me goes back to one point I've been thinking about more and more, which is what's the behavioral response, right? So there's some data that I saw in a report which I can no longer find, and it's annoying me because I read it on the web. I'm desperately looking for this. But basically what it said was, if you look at areas of China where you didn't have a big shock, you nonetheless have a huge behavioral response. People just aren't going out as much.
Yeah.
You can open up the movie theaters, but it doesn't mean they're coming back. And if you have second and subsequent waves of this virus, the behavioral shock might be bigger than the initial economic shock, but the two of them will get compounded. Yeah. So that's the problem, if we go down that road. So exactly, you're right on cruise ships. I mean, why on earth did we bail out cruise ships? Because if you think that there's a major behavioral change likely, it's if you go on this boat with 1,200 other people and one of them gets it, you'll be stuck in dock for a month. Yeah. Do you really want to take that chance? So that says to me that industry's toast, and yet, we went along and bailed it out, at least in the US. So let me push this back to you and then go back to the United States on this one. There was an interesting piece in the Financial Times by Megan Green, who's an affiliate of my center, on bailing out the oil industry. And what she said was, no, don't even think about it, right? But on the other hand, if I think about the political economy of the US, I can identify a dozen states. They tend to be Republicans. They tend to have balanced budget amendments, which means that they're heavily dependent on current revenues for spending. A lot of that are their carbon extractors, refiners, producers, think everywhere from Alaska to Louisiana, right? Mm-hmm. And they are about to get an awfully big shock because of this. So rather than sort of individual sectors, it would be interesting to think through which regions of the country are going to be most upset by this type of thing. What are your thoughts there?
Yeah, North Dakota in particular should be right at the top of our mind, right? Spare a thought for North Dakota because maybe it's good for the climate. It is good for the climate if the oil industry there shuts down, but this is a terrible way to do it in terms of the awful impact it's going to have on workers and families. I think Megan Green's piece was fantastic and it was right on the money. There are the political momentum or the political pressure for some form of oil bailout, I think is going to be very hard to resist. I'd be surprised if there wasn't some form of bailout. And so then the question is, are there good or bad ways to do this? And I think the answer is yes, because we're leaning towards, at the moment, the bad ways, which is to say, okay, let's throw, grants or loans at the oil companies. And I would much prefer to see us investing that kind of money in the workers and taking care of the people and helping to retrain for a different form of energy economy in the future, because we can move to an economy that is much less dependent on fossil fuels if we choose to. And, why wouldn't we do that at this point? I think it just makes sense.
Well, we would choose not to do so because the oil sector is critically important as it stands to the welfare, well-being and tax base of very, very important states if you want to win the Senate or if you want to win the presidency, etc. So, the lowest common denominator is bail rather than fail and then hope that they like you. Yeah. So there's I would say, an electoral politics built into this one. Let's go bigger. Let's go macro. We're getting some very good questions coming in and we'll turn to those shortly. But let's go macro on this one. So as a child of the Cold War, and as a student of international relations, I did my graduate work at Columbia, a student of Bob Jervis. I was used to a world in which there was, first of all, the Soviets, then there was NATO and us freedom-loving countries, and then the Soviets died, came back as Russia. The United States is still basically friends with the Europeans and the Canadians and all the other people. And then along comes the Trump moment, right? Along comes neo-nationalism, not just here, but globally, begins to change it. So two directions I want to push on this one. The first one is, why do I think now that the United States has more in common with Russia and Saudi Arabia than it does with the Europeans? And the second one is there not an argument that all governments will be making about strategic important sectors. So, for example, with airlines, I can imagine Virgin going to the wall, but as we see with the KLM Air France bailout, you're going to keep one. British Airways is probably going to get a bailout, right? I don't know if cruise lines fall into that. They're not strategically important. But your oil sector, surely that's strategically important. Are we going to see a kind of renationalization of these oil companies back to the old model of having national oil corporates? And this is how we're going to get there. So let's explore those two themes.
Yeah, so you definitely do see a triangle relationship between the US, Saudi Arabia, and Russia as the three largest producers by far of oil in the world. And so, you see President Trump trying to organize an agreement between them. But I will say, I think that was wildly overhyped, that his role in particular, the US role in organizing that agreement was far overdone, because that probably would have happened anyway, as the fact is that the US is a marginal net exporter at the moment and will soon become a net importer again. And so while it sort of was temporarily aligned in that sense, I think that its long-term interests are going to still be probably closer to Europe than the other two. And Saudi Arabia and Russia, they made an agreement that didn't actually involve the US at all, right? There was the US only promised to make production cuts that would be forced on them by the market, by the fact that the prices were coming down. So they didn't actually do anything different than what the market was suggesting in the first place. And now I'm forgetting, of course, the second part.
The second one's about the renationalization of oil and oil companies, because it's such a strategically important sector. Even if you want to make the green transition, one of my favorite examples for this is coking coal. The steel that you need for making windmills has to be done through coking coal, right? So do you open up coal mines if you want to get there, right? Yeah. We're all still going to fly for a while, even when this comes back, perhaps not as much, which means that you will still need these types of fuels. So if they are strategically important, do we see in this kind of neo-nationalist moment a rebirth of the type of national oil companies that dominated the world in the 50s and the 60s?
So I think the oil industry does a brilliant job often of talking about how security important it is. It does this thing called securitization, right? Where it claims that a strong American oil industry is in the vital national interests of the United States. And most of that is hogwash. That in fact—
Tell us why. Tell us why. Go on, that's really important. Tell us why that's hogwash.
That the US does have, an important interest in being able to supply its military if it's ever in a war, right? So that is important. But the US military consumes somewhere between 2 and 5% of US consumption of oil. So it's a very small provider, and there's no question that Texas and Louisiana can continue to supply the military's needs without any government support whatsoever. So that part of it is already taken care of. What this is mostly about is an economic question of distribution, right? Of redistribution of winners and losers. So the consumers of oil, which was you and I, anybody who's filling up their gasoline tank on a regular basis, benefit from lower oil prices, whereas the producers benefit from higher ones. And that's the struggle. And they sort of want us to believe that we should have higher oil prices for that benefit. The US has never had a nationalized oil industry. The closest it got to that was in World War II. And even in the face of this extraordinary war, the oil industry would not go along with that. And I don't see it. I know there is a lot more discussion about that topic now, but I'm skeptical that we're going to get to that point in this country. In other countries, in Europe particularly, it's much more plausible because the idea of nationalization is always found more fertile ground. Those policies.
But is there also an exporter-importer dimension here? And the exporters do not want control by governments; they like free markets, etc. And then the importers would actually like to have control over supply, and because it's insecure. Is there something in there?
That's interesting. I mean, there is, but there's also, if you look at Saudi Arabia and Iran and Nigeria, they all have national oil companies.
Right.
And so there's nationalization actually on both sides. And the US is particularly wedded to a capitalist model for better and for worse. And so I think nationalization is less likely in this country.
Yeah, I mean, a good example of that, a corollary, is the comparison between airlines. So basically, the British Chancellor has said, explore every other possibility. Literally, go find the change down the back of the sofa before you come to me. Because if you come to me, I'm taking ownership stakes.
Mm-hmm.
And when that was floated, Boeing's chief executive came up and said, "Oh, no way. No, we'll take the money, but you don't get ownership," right? So
Right.
yes, there's very much a different politics to this. Before we go to the Q&A then, let's just talk finally about, do a couple of scenarios and then the winners and losers. Let's suppose that there's an effective vaccine within 12 months. There's no recurrent virus waves. We do begin to bounce out of this quite quickly. What happens to the oil price, and what happens to, if you will, the politics of oil in that scenario?
Well, you could imagine, I mean, right now the price of oil is about $20 a barrel. You could imagine us returning to $40 a barrel under that sort of relatively rosy scenario relatively rapidly, maybe even higher. If it gets up higher than that, of course, you attract new production, and all of those production cuts that we've been adopting in the last month, they melt away, and so that stabilizes the price. So I don't see it going much higher than that. And that's still, let's keep in mind, much lower than January 1st of this year. It was $70 a barrel. So either way, this has been a big change for the US industry.
Can I ask a question that's somewhat off topic? Well, it's on topic, but it's not where I was going to go next, but I thought of it. Whatever happened to peak oil?
Right. So peak oil demand versus peak oil supply are so different, right? So this idea that we were going to run out of oil, it's sort of disappeared in a couple of different ways, but shale industry and the fracking revolution, I think, in some sense, crushed that idea that we would get to a point where we just didn't have enough oil in the geology of our Earth. Instead, the thinking now, I think, is much more about peak oil demand, and when the global energy system moves away from fossil fuels, in part, of course, linked to climate change.
So then let's do a second scenario, and then we'll go to questions. A much less benign one, rather than the bouncing V or the extended U, that we permanently shift down to a lower set of growth trajectories across the world, that consumers' expectations and producer expectations are revised down, that third of GDP, we really do lose it and we move into a different track. What happens to the oil industry then, and the centrality of oil to world politics?
Yeah, it's going to change dramatically. Of course, we have to work this out, but I think it's much more a country by country scenario, right? So there are going to be some countries, as I said, Canada among them, that are high production, high cost production countries that will just go wiped out and exit the business more or less completely. Whereas Saudi Arabia is going to be pumping oil until, the end of this century, I would expect, and quite a bit longer than that, in the sense that their oil can be produced at around $10 a barrel profitably. And so when they're able to do that so cheaply that it's hard to imagine that they're going to be kind of driven out of business under any economic scenario. The US is caught in the middle, and that's really why it's so complicated here. And I think most cost estimates are around $35 to $40 a barrel for oil producers. But what we saw in 2014, when the price of oil fell dramatically then too, was that at that time, the estimates of cost profitability was around $65 a barrel. And the frackers and the shale industry grew quite a bit more efficient and lean and productive. And so one never knows, what the next set of innovations might allow.
Yeah. So that's great. We're at the halfway point. So let's turn to questions. There's a whole bunch of them come here. If we don't get to your question, I do apologize, because we do have too many. So I'm going to have to pick and choose here. Following on from the themes that we've been talking about, I've got three of them grouped together here. So let's go with the first one. So this is from Tom Slate. Can shale oil even continue in a world of low price crude? If we get stuck basically at the lower end of the scale, does that just kill the shale oil industry permanently?
Yeah, so in the short term, shale persist, I think, and of course it'll be the leaner and low cost versions of shale that will persist. In the longer run, I don't know is the true answer. That I think the conventional oil is in the places with the right geology is always kind of at the bottom end of the cost curve, and it's the most profitable oil. It's possible that shale in the US would just get wiped out because of that. But that's a multi-year scenario, and there's so many unknowns in the next 2 years that would not be the one that would be at the top of the deck for me.
But thinking of the politics of this then, given that it's a huge number of small producers, that makes it a bit more difficult to bail out. If you've got one or two big companies and you can just funnel money to them, then, classic American bailout. If it's lots of small producers, as we see with what happened with the Small Business Association and the Paycheck Protection Program, that spells trouble in the sense that it's very hard to bail out like fractionalized industries like that.
Yeah, what we might see is the oil industry becoming a lot more like the tech industry, in the sense that small companies grow for the express purpose of being bought out by one of the giants, right?
By Google, right? Yeah.
By Google, right? And so, in the next little while, we're going to see a lot of mergers and acquisitions, I expect, in the oil industry because of the hard times. But regardless, we might see the kind of industry structure where Exxon and Chevron become the market makers that choose, okay, what do we expect are the best bets out there of these small fry, and we buy them up and let the other ones die.
Yeah, wow. So basically kind of like private equity scenario or writ large for the oil industry with lots of consolidation. Following on from this, let's talk about the politics beneath all of this. Tim Roberts, who one of our colleagues at Brown, is very interested in the climate change denial industry. And he asks, if we go to $10 to $20 to $30 a barrel, the company's profits, as along with their share price, gets totally hammered. What happens to the ability of these companies to fund those types of climate change denial networks? Does that put a crimp in those political ambitions? What do you think?
I do think that it shrinks resources, and so from that sense, it could be a net positive story if you're concerned about climate change. But I also think that there's a certain segment of the kinds of regulations or the efforts, the lobbying efforts for bailouts that are so important for this industry that those become, those are not surplus expenditures, those are essential expenditures. So if we think that the current expenditures are around $200 million a year by the oil industries resisting environmental legislation, maybe that shrinks, but it doesn't go away completely.
But if they want a bailout, or if we renationalize them, couldn't we just say, no, you don't get to do this anymore?
Yeah, if we renationalize, absolutely.
So Mark Suchman asked this one. On the renationalization of energy production, is there a potential climate gain to this? How would the politics of this shift of oil reserves were owned by the state rather than by private interests?
Yeah, there's a huge upside on the climate side for nationalization. I think to the extent that the government is helping out oil companies, it can and should expect equity stakes, and there should be rules attached to it. It shouldn't be a blank check of public money to a big oil industry that is benefited massively from the upside of capitalism and is resisting the downside risks of capitalism. So there is a role to play here and a way forward on the climate side. But the question is, the hard question is whether the politics of a Republican-controlled Senate would allow for those kinds of requests and rules on oil companies. Would they be put in place by a Republican-led Senate?
Right, fair. Another of our colleagues, Patsy Lewis, has asked this one. What are the likely implications for Guyana, which has just started oil production?
Yeah, so Exxon has said that it will continue to go ahead with the Guyana project, in the sense that it was a long-term exploration, not exploration, a production project anyway. I mean, this is something that they expected to unfold over decades. So I don't expect it will suddenly evaporate, but there is this question of, well, what happens if Exxon itself runs into trouble because of all of the difficulties in its home market? And those questions are anybody's guess.
Right. Leslie William Robertson asked the following question. How do you see the collapse in the oil price affecting current geopolitical conflicts and pressure points? The low price and challenge of storing oil suggests a diminished motivation for conflict to capture the resource, yet major wars drive demand for oil and might support the price. So in a sense, if it falls too low, does that create an incentive for conflict? Now, this is something that you've written about more than anybody else. So let's go for the Jeff Colgan opus on this one. What's the relationship between the oil price and conflict?
Well, I would like to be able to paint a mostly happy story on this, in the sense that, for instance, Saudi Arabia backing out of Yemen, as we've seen in the last couple of weeks, I think they painted it as a humanitarian story about, oh, well, we don't want to make things worse with the coronavirus outbreak. My skepticism about the Crown Prince's humanitarian instincts is very high. And so I think this was actually much better explained as a fiscal story, that they were trying to reduce what is a very expensive war machine. And so lower oil prices in that sense, I think, does drain the capacity, not immediately, not tomorrow, but over time, drain the capacity of oil producing states to get into wars, to get into foreign policy misadventures of various kinds. There is, that's my mostly positive story. There is a little worry, though, about the fact that President Trump does have, on some level, an incentive to engage in conflict with Iran, probably, because turmoil in the Middle East does tend to prop up oil prices. And so that is a very scary side sort of scenario. And you'd like to think that the White House would not follow that logic too far, but it's hard to say.
What about Nord Stream 2? This is a question that came in off of YouTube, so I'm sorry we don't have your name, unfortunately, but thanks for bringing it up. So how does Nord Stream 2 factor into this? The Americans have basically put sanctions on the Russian companies that were doing it. The Germans want it. The Germans have completely lost faith in the United States under the current administration and are trying to find ways to basically make it happen, because that's their energy security. How does that one play out?
Well, I followed Nord Stream 2 very carefully when I was in Copenhagen last year, because they were sort of the final turning point. And Nord Stream 2 seems like it's going to go ahead. It's basically cleared all of the major hurdles and obstacles. And so at this point, although the US has worked hard to oppose it, I think that the US has now lost the battle in that respect. And Germany is going to get Russian natural gas. The bigger question is whether the US is right in the long term to worry about German dependence on Russian natural gas, and whether that comes with political ties. Germany's leaders are betting that it doesn't, and we shall see.
Definitely. So here's another one from YouTube that brings us into interesting tertiary territory. What happens to tertiary industries in all of this? Are there major subsistence sectors that will always survive? What's the path for rebounding in services? And I would just add to that, let's think of this historically. When we think of oil crises in the past, the one that comes to mind is the 1970s. Large price increases, inflationary effects, et cetera, right? But this seems to be very different. It's quite the opposite. I mean, there's a massive deflationary effect, right, rather than that. But also, our countries' growth models and industries have dramatically changed, right? We're no longer making stuff. We're basically selling each other services. In a sense, we use more oil, but much less intensively. So walks through a couple of sectors. Basically, what happens if you mentioned fertilizers, but what about plastics and chemicals? Is this great because these guys have now got lower input costs, and that helps get away from the deflation of the current moment because of lockdown? And then services. I mean, beyond driving to work, nobody uses heating oil anymore. In the 70s, they used to actually pour kerosene into heaters in factories and burn it in the room, right? Nobody does this anymore. Is there a way in which oil matters less, even though we still think it's incredibly important?
Compared to the 70s, it certainly matters less for heating and for electricity. And what's crucial about that is that there are other fuels that can compete for electricity and heating, right? So coal and natural gas and wind and solar, they can all do that. The thing about oil is that it's king on transportation. And so that's where it matters most. And it continues to be sort of the lifeblood of the modern economy. That part hasn't changed. I do think that this lower oil prices is going to help a lot of sectors of the economy, like, Amazon or any other delivery business, which is of course benefiting massively by all of us being shut in. Well, they drive trucks, and so the cheaper fuel prices are going to help them a lot. It is going to help the airlines if they ever get some customers again, to fly cheaper, because about a third of the price of the cost of your ticket, right, an airline ticket, is fuel costs. So that's going to help. The ones that are really going to get slammed are the oil field services. It's not the big oil companies that you know of, like Exxon and Chevron, but the Halliburtons and the Schlumbergers and the Baker Hughes, which are huge oil firms that employ tons and tons of people who actually do a lot of the physical work of lifting oil out of the ground. Those ones are really getting destroyed in terms of their earnings and revenues over time.
A couple of other questions just popped in. One from John Irving, who's a local around here. I'm going to embellish this a little, right? Trump loves tariffs. So what's the prospect of a tariff on Saudi oil at $40? Take the difference between market, 12%, and apply the rest as a tax to the recovery to the US Treasury. Can't we benefit from this, in a sense, protect our oil, punish the Saudis, even though they're our allies, and basically get some rents in to basically help the bailout?
Yeah, so this is definitely one way of making sure that the revenues flow to American companies, or at least to an American government that can then redistribute it in some way, as opposed to foreigners. But remember that every tariff we put on foreign oil is going to hurt consumers as well, right? We're driving up the price for US consumers. And so this is not so much a national issue. This is an intra-American distributional issue, right? It's
right.
Producers versus consumers within the country, because we are, at this point in time, basically balanced between how much we produce and how much we consume.
Right.
There's sort of an equal weight on both of those sides.
Yeah, so it's not, sadly, tariffs are not always the answer. Well, who knew? Will we see the end of the use of the dollar for global oil trades? What do you think?
Well, that one has been around for as long as I've been watching oil politics, continues to get floated, but it's actually more in Mark's area of expertise than mine. I think that question is deeply connected to how long does the US remain the global reserve currency? And my understanding is probably a lot longer still, but
I would say a lot longer than us.
Okay.
Right. And basically, the basic story I tell all the time is that everybody's growth models are interdependent with each other. You can only have giant export platform models like the Germans to the extent that we run chronic deficits. Now, given that we run these chronic deficits, we pay for stuff in dollars. We're never going to make real stuff to valorize those claims on those BMWs that we're actually bringing in, right? So what happens is all those dollars go to the foreign banking system. They can't actually use them, because if you can't, you have a different currency, etc. So you have to turn it into an asset to make it not a liability in the balance sheet of these banks. So you buy treasuries. And then when you buy treasuries, that just comes back to us to allow us to do more stuff. And when you're basically 70% of all trade, 70% of all reserves, you're just not going anywhere. I mean, another interesting angle on this, though, that came in was a question that came in quite early off of YouTube. Are we witnessing a sort of Dutch disease lesson en masse? And what will we learn from it? Does the lesson for commodity exporters differ from the general lesson of lacking redundancy, having a diverse portfolio of companies and assets, a diverse economy, etc.? So just as oil, if you are Venezuela, if it drops, you're dead, right? In a way, the United States, and actually Brendan Greeley at the Financial Times is writing a book on this topic. The dollar is a kind of a commodity that we export to the rest of the world that everybody else has to use, but we're the only producer. And in a sense, that makes us lazy. We can have crazy politics and do whatever we want, because ultimately there's no alternative to the dollar. It's kind of like an equivalent to oil in that sense, although there seems to be no downside. It doesn't seem to drop the downside the way the oil does.
Right.
So, no answers, but definitely a set of interesting questions.
I mean, let me say on the Dutch disease that one of the components of the sort of resource curve generally is this huge volatility of the revenue flows, and that we are absolutely seeing en masse in that the US is experiencing it, lots of other countries are experiencing it, and in both directions, where the consumer countries, the net importers, love to see lower oil prices, but it hits very hard at the exporters. And one thing, if we're talking about kind of interesting, unusual geopolitical alignments, China gets a lot of its oil from Angola. And Angola's oil is very expensive, and they are going to run into deep trouble. And so what we might see is China consuming a lot more Saudi oil instead of Angola oil. And that creates an interesting dynamic where the US and Saudi Arabia have always had a close relationship. Will the relationship with China now become stronger for Saudi Arabia?
Interesting one. Just on the same point, before we move on to volatility, question just came in: why is China not taking this chance to dump dollars and kill the hegemony of the dollar? Because that's their national savings. And if they dump them all, they destroy their national savings. So you can do it, but it's a bit like Italy leaving the euro. You would basically destroy half of national savings in the process. So you'd be worse off than sticking with it, basically. It's kind of like putty. You're stuck with it.
There's a remarkable story, you know this better than I do, Mark, but that remarkable story of how in the financial crisis, apparently Russia went to the Chinese and said, let's work together to dump the US treasuries and really hurt the Americans. And that seemed, like a great idea from Russia's perspective, but China said, no way, we're holding most of those treasures. We don't want to lose all that value.
Absolutely, absolutely. There was back up to volatility. So Marco Vant, and then there was somebody else came in a similar topic. So I'm going to bring these two things together here. Marco's is, the shale question touches on the consideration that renewable energy's cost of capital has steadily fallen over the years. Naturally, volatility should also be considered. Does this event prove that oil and gas may not be priced properly in markets given the volatility that can arise? Let me link this to something else. Solar is killing fossil fuels in solid liquid gas order. When's the tipping point for more money going through renewables instead of gas? So we've said that because the price has fallen, you get the short term, if you will, delayed action on it. But let's consider the volatility as a problem, right? You don't get that vol with renewables. So if you want to invest going forward, surely you want something that's got low vol. This proves that oil and gas really is mispriced pretty much a lot of the time. Because if we remember 2006, what did it peak at? 146 a barrel? Yeah, right. And now it's negative, right? So that's the definition of volatility. So let's play with this volatility issue. I mean, if you're going forward and you're trying to secure your energy supply, you want to have, regular electricity, etc. You want something that's low vol. You don't want this stuff.
Yeah, so it's always been a boom bust industry going back, a century. It's very difficult to get away with that unless you have a worldwide oil cartel, which has only really ever been achieved once, which was under the Seven Sisters, these oil companies, Anglo-American oil companies in the 50s and 60s that could do it. But since then, we've had very high oil volatility, and that does, I think, make renewables more attractive because they can have steadier prices. But think about right now how natural gas is very often, the price of natural gas is linked to the price of oil. So natural gas prices are also very low. And if you're a natural gas power plant, you're sitting very pretty right now. You are out competing, my guess, on economics, you are out competing the renewables. When natural gas is this low, it's like, between $1 and $2 per 1,000 cubic feet.
Wow. Why is it linked? Because they're distinct things, right?
They are distinct things, but they are often linked in part to control the alternatives, I think, and also because gas consumers want to contract around something that gas producers can't gain. And so the idea is that oil prices, world oil prices are, exogenous. Nobody can mess with those too much. And so that's why gas prices are linked to them.
Right. Question that came in from Binish Pervez: what are the economic consequences for the US when they choose not to extend liquidity swap lines to China and Russia? Short answer, nothing, because ultimately they still need dollars. That's pretty much it. It goes back to that idea of the dollar as commodity. So we don't really have to worry about it because we're the only producer in that sense. Anything else that you want to talk about, Jeff? What haven't we covered? We're getting into the last 10 minutes.
Well, just on that point that Beanish asked about because there was this interesting arrangement between 14 central banks that the Federal Reserve was at the center of and helping them out. And then China and Russia were not part of that. And so there was this question, I think, temporarily about whether China and Russia were on their own in terms of managing the pandemic crisis. And then, Mark, you know this better than I do, but as I understand it, the Fed basically said any central bank that has assets in the New York Federal Reserve can borrow against them. And so they basically helped stabilize Russia and China as well, in the sense that they could use those assets.
Yeah, so the ECB can take dollar assets and then give them to China. And so basically, it's a kind of don't ask, don't tell. Right, that's really what's going on. Like so much of what the Fed is doing, because they, when you're buying ETFs and at the same time using BlackRock as the people to help you understand what's going on, there's a few conflict of interest questions there, in my opinion. But that's a different story. Like I said, anything else that you want to talk about?
Nothing that leaps to mind.
We've got a new one coming out, new one. Not really seeing the question. I wish I could see the question in that one, but I don't really see it. I don't know. Have we explored it? Have we exhausted it? Have we flogged the proverbial dead horse?
Well, I would say that the dynamics around OPEC are probably the continuing story here. That there is a question about how much they're going to be able to cut, and they made this almost 10 million barrels a day cut over Easter weekend. As I said, there were other cuts that were sort of promised by the US and other non-OPEC producers, but those were all market-driven cuts, so they're not real cuts. But OPEC actually was making a commitment to cut starting May 1st, right? So even though they made that promise, those cuts haven't come into force yet. And so one question here is, how does the oil price react once those cuts are actually in play?
So here's two questions. One of them came in, and the other one I just thought of that we can use in closing. Is OPEC of any relevance at all anymore?
So I have been arguing for years that economically it is not relevant. It is not relevant because they can't actually get agreements that they stick to. They say, okay, we make an agreement in Vienna, and there's a big splash in the newspaper headlines, and it actually does move the prices a little bit in the week afterwards.
Right.
But then if you look at, you actually follow the story, and of course it disappears from the media.
Right.
But the compliance on those agreements is abysmal. And it's very unclear that OPEC is actually changing any of its members' behavior, right? In terms of what they would have done otherwise. So when they make announcements like that, they're very often saying, here's what we were going to do anyway. And OPEC isn't actually driving the bus, so to speak. It's really Saudi Arabia that is signaling to the market, here's what we expect the future to hold.
And then a very simple one, but a very interesting one. Does a change of president in November, assuming such a change happens, assuming such an election happens, let's assume that happens as a change of president, does that have any bearing on this at all?
Well, I think it does matter in terms of the form of the bailout for the oil sector. I think it could change a lot in terms of to what extent we are helping oil companies versus either helping the workers or doing some sort of public equity stake from the US government getting. So that I think matters a lot. And of course, it's not just the president that matters, it's Congress that's going to matter. But to the extent that there could be a shift in political winds, that could be very consequential for the US oil sector.
Okay. Just one final question, and we'll close it out on this one, seeing as it's at a night. It was actually the first one to come into, so I've been saving it up. It's Chris Garrity asked the following question. I'm going to ask you particularly, Jeff. What major assumption, if any, underlying your views of international energy and economics have changed over the past 5-6 weeks? What's happened that's made you go, oh, I really need to kind of fundamentally rethink something?
That is a great one. I'm not sure this qualifies as a fundamental principle of IR, but when I first read about the possibility of negative prices about 6 weeks ago, oil analysts started talking about it. I thought, oh, come on, it couldn't get that bad. And then as I sort of started to dig into it and think about, well, maybe, what would the conditions be that could make that happen? It did start to seem like a real possibility. And actually 10 days before oil prices went negative, I was on Al Jazeera saying oil prices are going down, which is a thing I normally do not do. I do not predict oil prices.
Right.
There's too much randomness in it. But in this part, the sort of the fundamentals were just so glaring that I felt comfortable making that call.
I think it's a call which you can probably continue to make, at least for the foreseeable future.
If only I had some way of making money off of it. That's the
exactly. Well, I mean, you got this whole contango in the market whereby, the forward price is higher than the futures price, etc. So I'm sure there are some clever financial engineers somewhere making money off of it.
Yes.
but like you, I have no idea how to do that, and it's too complex, and it's much easier just to not bother. All right. Well, thank you very much, Jeff. This has been incredibly enlightening and actually entertaining at the same time, which is what we strive for. So your turn next. I think you should now interview someone else at Watson.
Sounds like
so that'll be the next one, and we'll go from there.
You're a very good interviewer. Thanks so much, Mark.
Okay, thank you very much.
Call it a day.